So first of all, bank reconciliation. So the syllabus tells us that we need to be able to apply our accounting principles and processes, so handwritten and using spreadsheets as well, to prepare our bank reconciliation statement. So what is a bank reconciliation statement? So the whole idea of these statements is that they illustrate that the business's cash records align with the bank's records. So it's this checking idea where you want to have that consistency between the records of different organizations, and this procedure is going to involve ensuring that happens. So we adjust the final balance in the bank statement to account for the transactions that the bank didn't include in its records. So you can see we've got a bit of a 5-step process here. We're going to go through each of these steps individually, and then we're going to have a look at them applied to a worked example as well. But first, let's have a look at what happens when we've got different balances. So the structure of the bank reconciliation statement is going to depend on whether the final balance in the bank statement has a credit or debit nature. So it can be really easy to accidentally use the wrong structure in your bank reconciliation statement. So it's really important to get your head around which way to lay it out, depending on what that nature of the final amount in the bank statement is, credit or debit. So if it is a credit balance, then that shows that the bank owes the business money. So it would appear where you've got credit balance as per bank statement as your first line, with that total on the right-hand side there. You would be adding your outstanding deposits, you would be subtracting your outstanding payments, and then you would have your debit balance as per the cash at bank account at the end there. Now, as opposed to this, if you have a debit balance, then that shows that the business owes the bank money, and we can call that a bank overdraft. And the bank reconciliation statement would show this by starting off with saying debit balance as per bank statement, so exactly the opposite to what our previous one said. Down the bottom, you can see we've got credit balance as per cash at bank account. So you're not going to have the same for each. So if the top says debit, the bottom should say credit, for example. It shouldn't be both debit and debit or credit and credit. In this case, we're adding outstanding payments and we're subtracting the outstanding deposits. So here is a bit of a summary of both. So a credit balance in the bank statement and a debit balance in the cash at bank. You need to add outstanding deposits and subtract those outstanding payments. And it's the opposite way around for the debit balance in the bank statement and the credit balance as per the cash at bank. You're adding those payments and then subtracting the deposits. Okay, so let's have a look at these steps that I mentioned earlier in a little bit more detail. So these are the steps that you need to follow to create that bank reconciliation statement. There's a bunch of things that you need to do in the lead up to actually figure out what figures to be putting into that statement. So it's about comparison between our different records. So that's the basis of our first 2 steps. The first step is comparing the bank statement's credit column with the listing of cash transactions debit column. And you also are looking at the bank reconciliation statement from the previous month if it has been provided. And when you're doing this comparison, you want to tick the items that correspond and identify any that have not been ticked, and then you make a note of those. Those are the ones that are going to then inform what you do later on in the process. And step 2 is just the opposite of that in terms of the different accounts. So instead of the credit column, you're looking at the debit column in the listing of cash transactions. And you are still looking at that previous bank reconciliation statement if it has been provided, and again, doing that ticking process. Step 3 is about your general journal entries. So based on the information that you have gathered with those items that have not been ticked in the bank statement, you want to do those general journal entries to account for those. So make sure you're not preparing general journal entries for the unticked amounts in the listing of cash transactions. This is purely about the figures that have not been ticked in the bank statement. Now, as you record each missing transaction in the general journal, make sure you then tick it off in the bank statement to show that the transaction has now been accounted for. This process is very much about keeping a record as you go with ticking and things like that, so you're not doubling up or missing things entirely. Step 4, you then post those general journal entries created in step 3 to the ledger. And finally, step 5 is where you actually create the bank reconciliation statement. So this is comprised of the listing of cash transactions, unticked items, and then the bank reconciliation statement from that previous month. So the final figure in the bank reconciliation statement should match the cash at bank accounts balance in the ledger. So you created that ledger in step 4, and this provides you a bit of a check to make sure that you've done the whole process correctly. A bit like where earlier on in your accounting career, you would have seen that you would have done the process of general journals and then posting to the ledger. A check to make sure that you've done that correctly is to then post those entries from the ledger into your trial balance. And the debit and credit columns in that trial balance should equal one another, and that shows that you have done it correctly. Usually it would be very rare that you would get balance amounts without actually having it correct. So in the same way, this has sort of built-in mechanisms where you can check if you're correct, because that ledger figure needs to match the ending figure in the bank reconciliation statement that you create in this step 5. So now we're going to have a look at all of those steps in context. So we've got a fictional business here, and we're going to use the information that we've been given to complete the general journal, post to the ledger, and then prepare our bank reconciliation statement as at the 30th of June 2021 in this case. So here is the sort of information that you're going to receive. First of all, you've got your bank statement, and then you've got your listing of cash transactions. And we also have our bank reconciliation statement from the previous month. We can see that it's the 31st of May, and we're accounting for the 30th of June, so that's the previous month. And we've also got the ledger, the last line from the ledger, so it's just an extract there. So it's the last line of the cash at bank account we can see before the bank reconciliation statement is created. So that transaction there occurred on the 30th of June. It was sales, and it's important that we have that figure, the $7,740 debit figure there, because that will then be used later in the process of doing this bank reconciliation. So we'll see that shortly. Okay, so let's go through all of those steps that we just outlined, and now we are applying it to this specific business scenario. So step one, we were doing that comparison between the credit column of the listing of cash transactions and the bank reconciliation statement from the previous month. So the bank statement's credit column and the listing of transactions, cash transactions, deposits column. So here we have then identified what items have not been ticked, and we've got the little extracts here. So if we have a look, we've got June 7, Duncan Industries for $44. If we go back to our previous slide, then we will be able to see that this is where we got this from. So we can see on June 7, deposit Duncan Industries for $44 is in the bank statement, but then it isn't accounted for in the listing of cash transactions. So that is where we're getting that information from. Now let's have a look at the other one. So we've got items not ticked in the deposits column of the listing of cash transactions. We've got sales for $900 on June 1. So this time, if we look at that bottom chart there, listing of cash transactions, the first transaction there is sales for $900, like we just saw, but that isn't included in the bank statement. So you can see how we did that comparison. We found one deposit was in the bank statement, but not in the listing of cash transactions, and vice versa as well. And we've divided those up so we can clearly see what is missing from where. Now, something to note here, when you're comparing the bank statement with the listing of cash transactions and the previous month's reconciliation statement, make sure you're looking at more than just the dollar amounts. So you can see when I was reading that out then, I wasn't just looking for $44 or $900. I was looking at the particulars as well and the date. So you can also look at check numbers and payment numbers, so you can make sure that you're not getting mixed up between different things. So, of course, you may have the same amount for sales. It may be a recurring figure, and you could easily accidentally tick the wrong thing if you only base what you're doing off the dollar amounts. So checking more than that is what is important here. Okay, so step 2, this time we're looking at just the same statements, but we're looking at the other columns this time. The bank statements debit column with the listing of cash transactions payments column. So again, we're dividing this up into the different categories. We've got items not ticked in the debit column of the bank statement, items not ticked in the payments column of the listing of cash transactions, and in this case, we also have another one, which is items that haven't been ticked in last month's bank reconciliation statement for $21 in this case. So now with that information that we have got, we now need to create our general journal entries. So making sure we're not creating general journal entries for the figures from the listing of cash transactions that haven't been ticked. So here we can see we've got our $44 for Duncan Industries and our $30 for our bank charges. But we don't have the, for example, $1,000 from Nourish Cafe or the $900 in sales from June 1st. So making sure to be aware of that distinction and only include the ones that you need. So as you record each of these, be sure to tick those off. So you would have written down something similar to what I had, where you were identifying what was not ticked. And once you have accounted for those transactions in your general journal, then make sure you tick it off straight away so you can make sure you're not doubling up at all. And now we post this to the general journal, to the general ledger. So step 3 feeds directly on to step 4, and we can see here why having that extract from the ledger of freshwater organics from the previous month, the 31st of May, was important, because in order to do the ledger, we need that final cash at bank balance from the previous month, because that then carries through as our opening balance for this month, which is June. So that's where that $7,740 comes into play here. We are then able to go from that and add the figures that we found that weren't ticked in the earlier steps. So again, that 44 and that 30 from Duncan Industries and the bank charges. And then we've got that final debit figure of 7,754. And our final step is creating our bank reconciliation statement. So here you'll notice that the ending figure in that bank reconciliation statement needs to match what that ending figure was in the ledger. So again, we can see 7,754, we've got that match. So this is another built-in check to make sure that you're on the right track. If it doesn't match, then go back and have a look at where you may have gone wrong. Now, in this case, we've got that credit balance in the bank statement and the debit balance in the cash at bank account. So we could see previously we had that debit balance. We could see from that extract of the ledger, 7,740 debit. And that immediately tells us what we then put into this bank reconciliation statement as well. So all of these figures are then coming in. We have that $700 we looked at earlier and the $21 from earlier as well. So these weren't included in the general journal entries and the general ledger, but they are included now. So this is outstanding deposits and outstanding payments that we include here.